Welcome to today's Explainer. We are diving headfirst into a massive financial mystery today. We're looking at a company called Natera, and we're exploring what I like to call the growth paradox. This is a fascinating story. It's about incredible scientific breakthroughs, massive market expansion, and this hidden financial contradiction that could literally make or break a portfolio. So think about this. What if a company is becoming the absolute most important name in precision medicine, but the stock is already priced in too much of that future? I'm not going to answer that for you right now, but hold on to that thought. That's the central question driving everything we look at today as we uncover the truth together. To understand this whole mystery, we've got to start with a number you just can't ignore. $752.8 million. That is Natera's latest quarterly revenue. Just think about the sheer scale of that for a second. This is a massive, incredibly successful operation, bringing in a staggering amount of cash in just 3 short months. And this brilliantly illustrates exactly what investors dream of, right? That revenue figure isn't just huge, it represents a 37.7% jump from exactly 1 year ago. Almost 40% growth year over year at that kind of massive scale is just phenomenal. On the surface, this looks like the ultimate growth story, the exact kind of momentum that creates absolute market darlings. But then, boom, we hit this number, negative $67 million. That's Natera's latest quarterly net loss. Talk about visual whiplash. How on earth can a company generating nearly $750 million in a single quarter, while growing at nearly 38%, still be losing that much money? Well, before we judge these financials, we really need to look under the hood. All right, Section 1, the evidence. Let's look at this precision medicine ecosystem. Before we decide if this stock is expensive or cheap, we need to know what investors are actually buying. Natera isn't just your run-of-the-mill testing app. They operate across oncology, women's health, and organ health. But at the absolute center of this ecosystem is Signatera. This tech doesn't just ask if a patient has cancer. It attempts to detect molecular evidence of residual disease to monitor if it might be coming back. It's an absolute game changer because it creates a recurring testing ecosystem around a patient for years, not just a one-off transaction. And you know what? The demand is absolutely exploding. Revenue isn't just going up because Natera hiked up their prices. They processed over 1.04 million tests this quarter, up from about 853,000 a year earlier. That's a 22.4% jump in sheer volume. The ecosystem is actively expanding and patients are directly benefiting. But this right here, this is the crown jewel, oncology testing. These tests jump from about 188,000 to nearly 297,000. That's a 57.2% spike in their most critical, recurring revenue segment. If you're a bull on this stock, this is the data you are framed on your office wall. Diagnostic tests are becoming a standard part of the treatment monitoring process, and Natera is completely leading the charge. Moving on to Section 2, the contradiction. Let's talk about the profitability problem. Okay, so we have this incredibly expanding volume, but here's the uncomfortable reality we have to face. If the opportunity is so huge and gross margins are sitting pretty at 64.5%, why aren't they profitable? We've got $752.8 million in revenue, yet we still have a net loss of $67 million and earnings per share at negative 47 cents. So what do you think? Is today's loss simply a smart, aggressive investment in tomorrow's dominance? Or is it a giant red flag about the underlying economics of this business? Well, there is a pretty important silver lining hidden inside that loss. The loss is actually shrinking. A year ago, their operating loss was over $110 million. Now it's down to $75.8 million. The net loss shrank from over $100 million down to $67 million. Plus, they are sitting on a massive war chest of $1.09 billion in cash and equivalents. So the crucial takeaway here is no, the company isn't profitable yet, but the financial trajectory is absolutely improving while revenue is accelerating. And that's a very different story than a company bleeding cash with stagnant sales. And believe me, management knows it. They recently bumped up their 2026 revenue guidance to between $2.85 and $2.91 billion. They're projecting gross margins to stay super strong at 64 to 66%, and most importantly, they expect to hit positive cash flow. So the whole narrative here is pivoting. It's no longer, can Natera grow? It's now, can Natera convert that massive growth into durable, long-term economics? Okay, let's dive into this next part. Section 3, the twist, the valuation trap. This is where the pros completely split from what a beginner might assume. A newer investor sees that 38% revenue growth and thinks, wow, I need to get in on this right now. But an experienced investor, they look at the market cap, roughly $47.9 billion, with a price to sales ratio around 17.2, and they ask, exactly how much am I paying for that growth? At these multiples, you aren't paying for Natera as it exists today. You are paying for what Natera could become. When market expectations get this enormous, the company doesn't just have to succeed, they have to flawlessly, continually beat those sky-high expectations. Wall Street's own targets actually reflect this tension perfectly. Analysts are generally pretty bullish on Natera. The price targets are all over the place, ranging from a low of $280 to a high of $375. But when you take the average target of roughly $336.74 and compare it to a recent share price around $325, well, that implies an average upside of only about 3.66%. The debate isn't whether Natera has potential. Literally everyone agrees it does. The debate is how much that potential is actually worth today. To complicate things even more, Natera pays no regular dividend. Zero. There is no cushy 3 or 4% income stream keeping you warm and protecting your capital while you wait for those profits to show up. For income investors out there, this means your return depends entirely, 100%, on future earnings growth and the valuation expanding even further. All right, Section 4, Synthesis. It's time for the bull versus bear debate. We've reached the climax of this explainer. We've got to frame this as a choice between two totally competing stories, and let's start by deliberately attacking our own thesis. Here's the bear case, plain and simple. The risks that could break this stock are severe. Unrealistic valuation expectations, a looming profitability timeline, reimbursement risks, and rising competition. The ultimate danger? If that 30+% growth starts to slow down while the valuation remains sky high, that is a very steep fall. But we've got to counter that immediately with the Bell story. Because honestly, the momentum here is undeniable. They literally just crossed 1 million quarterly tests. Oncology is growing at over 50%. Overall revenue is up nearly 38%. Management just raised their guidance, and there is a clear projected path to positive cash flow. If they just keep executing like this and clinical adoption keeps expanding, today's steep, expensive price tag might actually look like an absolute bargain a few years down the line. So, which story wins? Section 5, the final verdict. The growth story versus the valuation story. Now, what's really interesting about this slide is the nuance. This isn't just a blind buy or a panic sell. Look at the indicators. Revenue, volume, margins, and cash are all flashing a strong green. But profitability and valuation risk, those are glowing orange and red. For a conservative investor, this is a clear wait. But for an aggressive growth investor, it's a selective buy on pullbacks. The underlying business fundamentals are highly attractive, but you really want a better risk-reward setup before blindly chasing a massive run-up. I really want to leave you with this final thought today. Natera doesn't need to prove that it can grow. It already is. The real test is whether earnings can catch up with the expectations investors have already paid for. It's such a fascinating paradox. When you're buying a piece of the future, you always have to ask yourself, are you getting in early? Or has the market already charged you full price for a tomorrow that hasn't even happened yet? Thanks for joining me on this explainer, and as always, keep asking the hard questions.